The problem with options is knowing which ones to buy and sell. Let me give you an example. Check out these 5 put options with the same delta. Which one gives you the best ROI? Can you rank them from 1 to 6? In today's video, I'll teach you how to analyze put options in 60 seconds or less. Let's get started. First, there are 2 types of options, calls and puts. A call option or call is a contract that gives the option buyer the right to buy an underlying asset at a specified price within a specified time period. And a put option or a put is a contract giving the option buyer the right but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. We're going to focus on selling puts in today's video because if you want to get rich with a proven calculated approach, this is the way to go. Why? Because selling puts generates immediate income to the put seller because you keep the premium if the sold put is not exercised by the buyer and it expires out of the money. Rule number 1, only sell puts on stocks that you want to own, and rule number 2 is see rule number 1. Let's jump over to my free option analyzer and I'll show you how easy it is to analyze and sell put options. We're now at beastmodeanalysis.com looking at the option analyzer on the top part of our screen, and the bottom part of our screen is from Thinkorswim because I wanted to show you where the data is coming from. So our first step is we want to go ahead and sell an out of the money put, and we generally speaking want to get the probability at about 30% and we want a delta of approximately negative 0.3. So that's our first step. We already put in our Google name, G-O-O-G-L, and then the next is the date sold. Now it's Sunday as I'm recording this on the 4th, so I'll actually be able to sell this on the 5th. And then the next thing, we're going to drop down here to our option chain, and here we can see we're looking at the December 9th option, and it's 5 days out. And since it's 5 days from Sunday, that means it would be 4 days out from tomorrow. So we're going to go ahead and put in 4, and we want to do one option contract. And an option contract is 100 shares, so we're just going to put in 100. And then our next step is we want to put in our share cost, or in this case, the put strike. So now we're going to scroll down and we want to look for a put strike that is about a delta of 0.3. So you can see we've got our choice of a negative 0.35 or a negative 0.25. We're going to go ahead and run with the negative 0.25. So we can come up here and we can see on our delta, and we're going to put negative 0.25. And that's the one we're selecting, and our strike price is going to be $98. So all we do is put in 98 here, and then next we've got our credit or share price. In this case it's going to be a credit, and right now the bid on that is going to be 53 and the ask on it is going to be 55. So when we sell this, we're going to get 53 cents per share. So now we're going to come over here and our credit is going to be 0.53. And the minute we put this in, a lot of things are going to happen. We can see for each contract that we sell, we're going to receive $53. And here it shows us our annualized ROI is 49.3%. Our expiration date is going to be December 9th, and we can see that's the expiration date right here. Now, if we look a little further to the right, if you're really quick, you're going to notice our annual ROI is 28.1%, but over here it's showing 49.3%. And I want to point out that difference and why. So if we look over here, we can see our days out is 4, but if we change this to 7 days out, you're going to notice that it's just about identical. That's just a little bit in the math and how it computes everything, but it is essentially the same. So anytime you've got less than 7 days or more than 7 days, it figures it out on a daily basis. So in this case, we want it 4 days, and that's giving us an annualized ROI of 49.3. Now in a future video, I'm going to show you guys the wheel strategy, and we've got a section that makes it really easy. But right now, I want to show you our option desired annual ROI and how we can back into an option that's going to give us the ROI that we want. So let's say we're interested in Google, which is trading at $100 right now, and we want to get a 30% annualized ROI. Then this is going to tell us that if it's days to Now in a future video, I'm going to show you guys the wheel strategy, and we've got a section that makes it super easy to do. But right now, I want to show you how we can back into an annualized ROI. So let's say we want to get a 30% ROI, and right now we know Google is trading at $100, so we're going to put in 100, and let's go ahead for days for expiration and put 12. Then this tells us that we want to look for a bid price of 99 cents. So now let's jump over to Thinkorswim and see what we can find. So for Thinkorswim, we can see this one is 12 days out, so we're going to open up that option chain, and now let's scroll down, and what we're looking for is 99 cents roughly. And where is that going to come in? Right here. We've got one at 96 and 98. This is going to be our closest one, so this is going to be the $96 strike price. So we're going to put in 12 days, 100, and our strike price is 96, and we're going to be getting 0.96 per share, 0.96, and now you're going to see our annualized ROI is 30.4. So if you want to sell options on a regular basis and you just want to focus on a return, this will back you into which one to sell quickly and easily. So which put option should you sell? And this is going to be news to most of you. So I've gone ahead and put in 4 different Google options. Our date sold is all going to be the same. It's going to be Monday the 5th. And then our days out. This is our next option, which is 4 days out. The one after that, 11, 18, and then 25. 100 shares, which is 1 contract for each. And then this is our share price. And this is all determined on our delta because we're trying to get about a 0.3 delta. And in the case of the one that's 4 days out that expires on the 9th, the closest we could get was negative 0.25, and this is our credit share per price. Everything is broken down, and we've got our probability in the money. So we've got the lowest chance of this one being in the money, which means it's the highest chance for us to collect those premiums without ever having to buy the stock. Oddly enough, our one that is the farthest out actually gives us the highest chance of being put the stock, and this is what I want to focus on right here, our annual ROI. When we keep it short and right in front of us, it's going to be 49.3% over 4 days. Over 11 days, it goes down to 41.4%, and if we go out almost 1 month, 25 days out, it's going to be 27.4%. So our worst return in this case is selling the one that is 1 month out. And you're going to notice on my option analyzer that this number here is in red, and that's because if it's below 30%, I automatically have it coded to be red just as a warning that's saying, hey, this isn't what I'm normally looking for. So our whole lesson right here is your most profitable options to sell are going to be the ones that expire the soonest, and that's because they're taking advantage of the theta decay. So here we've got everything is right around a 0.3 delta, and we've got a difference in return between 49.3%, which expires in 4 days, or only 27.4% for the option that expires 1 month out in 25 days. This is huge, and this is why I love to sell weekly options whenever I can. And now for our last screen, I just wanted to show you all 6 of the different stocks that I input in. We tried to keep it at around a 0.3 delta, and you can see our annual ROI varies quite a bit, with a low of 15.8% for Coca-Cola down to a high of 94.8%. And if you're going to be looking at selling puts or covered calls, this is where you want to do it. You want to simply put them in, put in the numbers, and then you can see what the annual ROI is going to be, and make sure you keep that delta as close. And make sure you keep your delta as close as possible to whatever delta you're using. Now, most of the time, I'm at around a 0.3 delta if I'm using the wheel strategy, or if it's a stock that I'm really bullish on. Now, sometimes I might be more conservative and drop all the way down to a 0.12 or a 0.15. It just depends on the stock and what my goals are. And then the last thing, on the far right-hand side, we can see if we did all of these at 1 contract each, our total weekly income would be $542.29. Our annualized ROI would be 33.7. Our estimated monthly income would be $2,349.92. Our estimated annual income, not bad, just a little over $28,000. And our cash needed for all of our puts would be $83,650. So let's just expand this out and say you had $84,000 that you could put on the line, and you could do this every week. This is a way that you could actually make $28,200, and this is powerful, and this is the power of selling puts. When you sell puts, you generate immediate income, and in a worst case scenario, the stock goes down and you're able to buy it at a discount compared to the price of that stock today. Think about this. If you sell an at-the-money put and the stock trades sideways, you make money. Conversely, if you buy an at-the-money call option and the stock trades sideways, you will lose money. If you do puts right, it's an easy way to make money and grow your wealth with consistent returns. Here are 5 put tips to never forget. Number 1, only sell puts on stocks that you want to own. Number 2, the lower the delta, the more likely your put will be out of the money, which means you get to keep the put premium and never have to buy the stock. Number 3, selling weekly puts has less risk and more profit than selling monthly puts or leaps. Number 4, when comparing options, make sure your deltas are similar in value. And number 5, my goal is a 30% annualized return when I'm selling puts. Today I covered selling puts, and in a future video I'll cover selling calls, and then I'll show you how we can use puts and calls with the wheel strategy to supercharge our profits. For example, in October I made a 215% annualized ROI by running the wheel strategy on just one stock, and these returns are easier to get than you think. Okay, let's go ahead and answer the question of which put is our best option to sell. Based on the annualized ROI, our best put to sell is the UEC, which is Uranium Energy Corporation, because it has the highest ROI by a huge margin. Just remember, my number 1 rule is to only sell puts on stocks you want to own. So if UEC is not for you, then choose between Nvidia and Google or the stocks of your choice. Hopefully this video has shown you that if you are not comparing the annualized ROIs, then you really have no clue which options offer the best returns. And if weekly options are available, this is a great way to maximize your ROI with less risk than the monthly options, and I'll bet that no other channel has taught you that. My option analyzer is free to use at beastmodeanalysis.com, and all I ask is that you give me a thumbs up if you like this video. Peace, and I'll see you soon.